One of the biggest financial shifts of our lifetimes is already underway, and most people are not watching it carefully enough. The US dollar is no longer moving the way it moved when I was younger. Oil prices are rising, inflation, risk is coming back into the system. Global trade is no longer moving through one single center the way it did for most of the modern era. And for the first time in a very long time, the United States is beginning to lose pieces of the dominance it once had over global money, global trade, and global capital flows. That does not mean the dollar disappears tomorrow. That does not mean America collapses next year. That is not how world orders change. World orders change slowly. Then suddenly they change through incentives. They change through debt. They change through the decisions of central banks. They change through trade routes, payment systems, military power, energy flows, demographics, technology, and trust. And when those forces begin to move together, they create some of the largest opportunities and some of the largest wealth destruction events a generation will ever see. That is why you need to understand what is happening right now, because the people who see this clearly will not simply protect their money. They will position themselves for a world that is different from the one that made the last generation wealthy. The people who ignore it will keep assuming that what worked for the past 40 or 50 years will keep working exactly the same way for the next 40 or 50 years. That is usually how investors get hurt. They do not get hurt because change happens. They get hurt because change happens while they are still using an old map. So let me explain the map. After World War II, the United States did not merely become a powerful country. It became the center of the financial system. The dollar became the world's reserve currency. That means other countries needed dollars to settle international debts, buy oil, price commodities, and conduct a huge amount of global trade that gave the United States what economists call an exorbitant privilege. It meant America could run deficits more easily than other countries. It could borrow cheaply. It could print and spend in a way that would have destroyed weaker countries because the rest of the world still wanted dollars, still held dollars, and still trusted dollar assets. For decades, that system worked very well for the United States. It created deep capital markets. It pulled global savings into us assets. It made the dollar the place money ran to in a crisis. It helped make the United States stock market the main wealth building machine for millions of households. But every privilege has a cost when it is abused. For too long, if a country borrows too much, prints too much, sanctions too aggressively, weaponizes its financial system too often, and assumes the rest of the world has no alternative, eventually other countries begin to ask a very simple question. What happens if we need a plan B? That is the question being asked right now. Countries are not all asking it for the same reason. Some are asking it because they fear sanctions. Some are asking it because they want more independence. Some are asking it because they see the American debt problem. Some are asking it because they believe the next phase of growth will not be led only by the West. But they are asking it. And when enough countries ask that question at the same time, the world order begins to shift. This is why the phrase changing world order matters. It is overused, and many people use it to create fear. But the underlying idea is real. Over the last 100 years, every major change in the global financial order created huge winners and huge losers. It happened after wars, it happened after inflationary periods, it happened after debt cycles reached extremes, it happened when one power rose and another power became more stretched, and it is happening again. Look at the numbers. The BRICS countries and related emerging powers now represent a much larger share of global output by purchasing power than they did in the past. Nations like China, India, Brazil, Russia, South Africa, the UAE, and others do not behave as if the old Western-led system is the only possible system anymore. Meanwhile, the Western alliance that built the post-war order is no longer as dominant in global economic weight as it once was. That does not mean the West is finished. It means the world is becoming more multipolar. That distinction matters. A collapse is one thing. A dilution of dominance is another. Most investors confuse the two. They either say nothing is changing, which is wrong, or they say everything is collapsing tomorrow, which is also wrong. The truth is more important and more useful. The dollar is not disappearing. The dollar is losing some of the monopoly power it once had. That process is slower than the alarmists think, but faster than the complacent people think. In 2016, the dollar represented roughly 65% of global foreign exchange reserves. By 2024, that number had fallen closer to 59%. By 2025, it was closer to 57%. That is not a one-day crisis. It is a trend. And in my experience, the most important changes in markets often appear boring at first. They look like small percentages. They look like slow reductions. They look like technical details that ordinary investors ignore. Then one day, people realize the foundation beneath them has changed. The reason this trend accelerated is also important. After Russia invaded Ukraine, the United States and its allies froze Russian foreign reserves. Whether you believe that action was justified or not, it changed the calculations of every country that was not fully aligned with the United States. The lesson many governments took was simple. If our reserves are held inside a system controlled by another power, they can be frozen. So they began to diversify. They bought more gold. They looked for ways to settle trade in local currencies. They explored payment systems that bypassed the dollar. They reduced some exposure to U.S. treasuries. They began to build rails for a world where the dollar remains important but not absolute. China is the clearest example. Years ago, China held a much larger share of its reserves in U.S. treasuries. By 2025, that share had been reduced meaningfully. At the same time, China built its own cross-border payment system, often described as CIPS, to facilitate transactions connected to the yuan. That does not replace the dollar overnight, but it creates another rail, and another rail changes behavior. Then you have bilateral trade settlements, where countries settle invoices in their own currencies instead of using dollars as the middle step. You see this between countries that want to reduce exposure to the U.S. financial system. China, India, and Russia have all had incentives to experiment with this. You also have central banks buying gold at a very fast pace. Gold has no yield. It is not an efficient modern payment system. It cannot be sent across the world instantly to settle trade. But gold has one powerful feature: no government can print it. And in a world where trust in paper promises weakens, that feature becomes more valuable. Then there are ideas like BRICS Pay, payment systems designed to allow participating countries to transact more directly in their own currencies without depending as much on the Western-controlled SWIFT network. There are experimental systems such as mBridge, where central banks explore digital settlement frameworks involving China, Hong Kong, Thailand, the UAE, Saudi Arabia, and others. There are proposed settlement units tied partly to gold and partly to baskets of BRICS currencies. Some of these systems may fail. Some may take far longer than people expect. Some may remain small. But the point is not that they replace the dollar immediately. The point is that the incentive structure is changing. You do not need to replace the dollar completely to weaken it. You only need enough countries to use it less. That is how dominance is diluted. It is not destroyed in one blow. It is reduced through thousands of decisions, each of which seems small by itself. A central bank buys more gold. A country settles an energy trade in a local currency. A company invoices in yuan. A sovereign wealth fund increases exposure to India. An institution reduces its expected return assumptions for U.S. stocks. A family office adds emerging markets. A pension fund diversifies currency exposure. None of those steps looks dramatic together. They describe a new world. Now, this is where the average investor has to be careful. When people hear that the dollar is weakening, they often jump to extreme conclusions. They sell everything. They buy only gold. They chase crypto. They panic into commodities. They abandon U.S. stocks. That is not a principled approach. A principle is not a reaction. A principle is a rule for how to think clearly when the environment changes. The right way to think about the dollar is that it still has enormous strengths, but those strengths should not blind you to the trend. The dollar is still used in a very large share of global foreign exchange transactions. It is still a major share of global payments. U.S. markets are still the deepest and most liquid in the world. The United States still has the strongest capital markets, the strongest technology ecosystem, enormous military power, and leadership in areas like artificial intelligence, semiconductors, and biotechnology. When a crisis hits, money still tends to flow toward the United States, not away from it. That tells you something important. The dollar is not dead. It is over-owned, assumed, and increasingly challenged. Those are different things. The euro is not a perfect replacement because Europe has debt problems and political fragmentation. The yuan is not a perfect replacement because China has capital controls, which makes many countries uncomfortable holding it as a true reserve asset. Gold is not a perfect replacement because it is not a modern settlement network. Bitcoin has strong arguments from some investors, but it is too volatile to act as a reliable short-term reserve asset for most institutions. So the dollar remains central because the alternatives are flawed. But central does not mean invincible. Dominant does not mean permanent. Resilient does not mean immune. That is the nuance investors need. The most dangerous thing in investing is not fear, it is certainty. The certainty that the past will repeat exactly. the certainty that one country will always dominate, the certainty that one currency will always be trusted, the certainty that one index fund is enough for every future. Certainty makes people concentrate risks without realizing they are doing it, and that is exactly where many American investors are today. The average American investor has a very large share of their portfolio in U.S. markets, often through the S&P 500. For the last several decades, that made a lot of sense. The United States had extraordinary companies, strong profit growth, deep markets, innovation, and capital flowing in from everywhere. The S&P 500 became the default answer. It was simple, it was efficient, it worked. But good investing requires asking whether a thing that worked so well in the past is now priced as if it will keep working the same way forever. That is the question, because over the next decade, many large institutions expect us returns to be lower than what investors have grown accustomed to. Vanguard, for example, has projected a more modest range of annual returns for U.S. stocks over the next decade than the returns many investors. Remember, from the last cycle, international markets are expected by many institutions to do better from today's valuations. J.P. Morgan has shown more optimism toward emerging markets. Fidelity has also pointed to stronger long-term potential in international or emerging market equities. The reason is not complicated. If one market has become expensive, concentrated, and heavily owned, while other markets are cheaper, less owned, and have stronger demographic or growth tailwinds, forward returns can shift. That does not mean U.S. stocks become bad. It means the risk-reward may not be as one-sided as it used to look. One of the biggest risks is concentration. The top 10 companies now make up a very large share of the S&P 500. When you buy the index, you may think you are buying 500 companies. But in practice, a significant portion of your money is going into a small group of mega-cap technology companies. These are remarkable businesses. Many of them deserve to be large. But concentration is still concentration. And when a portfolio is concentrated in one country, one currency, one valuation regime, and a small group of dominant companies, the investor may be taking more risk than they realize. This is especially true if the investor believes they are diversified just because they own an index. Diversification is not a word. It is a reality test, you ask. What would hurt me? Would a weaker dollar hurt me? Would lower U.S. equity returns hurt me? Would a commodity shock hurt me? Would emerging market outperformance embarrass me? Would a different world order make my portfolio too dependent on yesterday's winners? If the answer is yes to all of those, then you do not need panic. You need balance. That is where the opportunity is. The world is not getting smaller. The world is getting bigger. China may continue to grow in economic importance even with its serious problems. India is one of the most important long-term stories in the world because it has a huge population, a younger demographic profile than China, and a rising level of technological ability. Emerging markets as a group may represent a much larger portion of global market capitalization in the future than they represent today. If that happens, American investors who own almost nothing outside the United States may be underexposed to one of the biggest changes of the next several decades. Again, this does not mean you abandon America. That would be a mistake. A person who says America has no future is not thinking clearly. The United States still has deep advantages that are very difficult to replicate. It has world-class companies. It has a culture of innovation. It has capital formation. It has entrepreneurship. It has the reserve currency, even if that currency is being diluted. It has the military and institutional infrastructure that still make it the first safe haven in many crises. So the right question is not whether to own America or not own America. The right question is whether you should own only America, and for most investors, I believe the answer is no. When the world order is shifting, the most powerful strategy is not prediction. It is diversification with a clear understanding of why each piece exists. You do not have to know whether China overtakes the United States by a particular year. You do not have to know whether India becomes a $10 trillion economy by a particular date. You do not have to know exactly how fast the dollar share of reserves falls. You do not have to know whether BRICS payment systems become large or remain secondary. You do have to know that these probabilities are no longer zero. And when important probabilities are no longer zero, a well-constructed portfolio adapts. That is how I would approach this. First, I would not go all in on the United States. That does not mean I sell all U.S. stocks. It means I stop assuming that one country should represent my entire future. If I am building a portfolio for the next 10, 20, or 30 years, not 2 years, I want exposure to where growth may emerge, not only where growth already happened. Second, I would look seriously at international and emerging markets. A simple international index fund can accomplish a lot for many people. It does not require heroic stock picking. It does not require pretending to know which country wins. It simply recognizes that growth value and demographics may exist outside the United States. If the institutions are wrong and the U.S. continues to dominate, that is fine. You still own the U.S., but if they are right and international markets outperform from today, starting point, you are not standing completely outside that shift. Third, I would think about precious metals differently than many investors do. I have never believed gold should be treated like a magic solution. It does not produce cash flow. It does not innovate. It does not build products. It sits there. But sometimes sitting there is the point. When central banks are buying gold because they want a neutral asset that cannot be printed or sanctioned in the same way as foreign reserves, investors should at least understand the signal. Gold is not a growth engine. It is a hedge against certain kinds of policy and currency risk, in small amounts that can be useful. Fourth, I would not ignore commodities. If emerging markets grow, they need energy, metals, copper, food, and the physical inputs of modernization. If the dollar weakens, commodities priced in dollars can respond. If supply shocks occur, commodities can offer a kind of insurance. I would not chase commodities blindly. They are cyclical. They can be brutal, but in a changing world order, owning some exposure to the real things the world needs to function can make sense. Fifth, I would still own the United States. That may sound obvious, but it is important. A changing world order does not mean the old leader disappears. Britain remained important after it lost its absolute dominance. Europe remains important despite fragmentation. The United States will likely remain a central force even as the world becomes more multipolar. The mistake is not owning us assets. The mistake is assuming us assets are the only assets worth owning. There is a difference. This is why I do not see the current environment as a panic moment. I see it as a signal. The next 10 or 20 years may not look like the last 10 or 20 years. The returns that came from falling rates, globalization, U.S. tech dominance, dollar strength, and index concentration may not repeat in the same form. If you assume they will, you may be disappointed. If you adapt early, you may benefit. The key is to make small, rational adjustments before everyone is forced to make emotional adjustments later. That is one of the most important principles in investing. Move early enough that you are acting from thought, not from fear. Because by the time most people feel the need to diversify, the easy opportunity may already be gone. That is how cycles work. In the early stage, people ignore the shift. In the middle stage, they debate it. In the late stage, they rush into it. The best opportunities usually belong to the people who recognized the change before it became obvious. That does not mean they predicted everything perfectly. It means they understood the direction of travel. And the direction of travel is clear. The dollar is still powerful but less unchallenged. The United States is still dominant but less alone. Emerging markets are still risky but more important. Gold is still imperfect but more relevant. Commodities are still cyclical but more strategic. The S&P 500 is still excellent but more concentrated. The world is still driven by growth, but that growth may be distributed differently. So what should you do? Do not panic. Do not sell everything. Do not chase fear. Do not assume a dollar collapse. Do not believe that every alternative system will succeed, but also do not sleepwalk. Do not assume the next decade will reward the exact same portfolio as the last decade. Do not assume that 80% U.S. exposure is automatically safe just because it was rewarded before. Do not assume that the dollar's past dominance guarantees its future dominance. Do not assume that the rest of the world will wait politely while America solves its debt problem. That is not how systems behave. Systems seek balance. When one part of a system becomes too stretched, pressure builds elsewhere. When debts rise too far, currency risk rises. When sanctions reveal the power of a reserve system, other countries seek alternatives. When valuations become stretched in one market, capital looks for better value in another. When demographics weaken in one region and strengthen in another, future growth shifts. When commodities become strategically important again, real assets regain attention. These are not political opinions, they are cause and effect relationships. And when I look at the cause and effect relationships today, I see a world where the smartest investors are not abandoning the United States, but they are no longer assuming the United States is the only answer. They are spreading risk. They are looking beyond home bias. They are watching gold flows. They are watching emerging markets. They are watching the dollar's share of reserves. They are watching trade settlement systems. They are watching the concentration of the SP 500. They are watching the gap between past returns and expected future returns. They are doing what good investors do. They are asking, what if the world changes? And then they are building portfolios that can survive more than one answer. That is the heart of this issue. A fragile portfolio needs one future to happen. A resilient portfolio can handle several futures. If America dominates again, a resilient portfolio benefits. If the dollar weakens gradually, a resilient portfolio is not destroyed. If emerging markets outperform, a resilient portfolio participates. If commodities rise because the world needs more resources, a resilient portfolio has some protection. If gold becomes more important as a neutral reserve asset, a resilient portfolio is not completely absent. If U.S. valuations compress, a resilient portfolio has other engines. That is what investors should want. Not drama, not ideology, not panic. Resilience. Because the next decade will probably test assumptions that many investors have never had to question. For a long time, an American investor could simply buy US stocks, hold dollars, ignore the rest of the world, and be rewarded. That may still work, but it may not work as well as before. And if it does not, the difference between preparation and complacency could become very large. The opportunity here is not that the dollar dies. The opportunity is that the world reprices. When the world reprices, capital moves. When capital moves, asset classes that were ignored can outperform. Countries that were owned can attract money. Currencies that were dismissed can become more relevant. Commodities that seemed old-fashioned can become necessary. Gold that seemed unproductive can become a form of trust. And portfolios that looked boring because they were diversified can suddenly look intelligent because they were built for more than one world. That is why I believe this may be one of the biggest opportunities of the next decade. Not because there is one magic trade, not because there is one perfect asset, not because China automatically wins or America automatically loses, but because the distribution of power, money, and growth is changing, and most investors are still positioned as if it is not. That gap between reality and positioning is where opportunity lives. If everyone were already diversified globally, there would be less opportunity. If everyone already understood the dollar was being diluted, there would be less opportunity. If everyone already had enough exposure to emerging markets, gold, commodities, and non-use assets, there would be less opportunity. But most people do not. Most people are still anchored to the last cycle. They are still looking backward. They are still measuring safety by what recently worked. That is human nature. People extrapolate. They assume the winner of the last race will win every future race. Sometimes that is true, often it is not. In markets, the greatest danger comes when a good idea becomes so universally accepted that people stop seeing its risk. U.S. exceptionalism has been a good idea for a long time. The dollar's dominance has been a good idea for a long time. The SP 500 has been a good idea for a long time. But even good ideas have prices. Even good ideas can become crowded. Even good ideas need to be balanced. So I would not treat this as a call to abandon what has worked. I would treat it as a call to update the playbook. Own the United States, but do not own only the United States whole dollars. But understand dollar risk. Respect the SP 500, but understand concentration. Own growth, but own some real assets. Look at emerging markets, but size them prudently. Use gold as a hedge, not as a religion. Use commodities as insurance, not as a fantasy. Think in decades, not headlines. That is how you survive and benefit from a changing world order. The investors who do best in these periods are rarely the people shouting the loudest. They are the people quietly adjusting. They are not trying to win an argument on television. They are not trying to prove that America is finished or that nothing can ever change. They are simply asking, where is the world going? What is priced in? What is ignored? And what would protect me if my assumptions are wrong? That is the right mindset. Because the next decade is not likely to be defined by one country disappearing or one currency collapsing. It is more likely to be defined by a gradual redistribution of power, a little less dollar dominance, a little more gold accumulation, a little more local currency trade, a little more emerging market weight, a little more global competition, a little more pressure on U.S. debt, a little less certainty that American assets always deserve the highest premium. Each of those changes can look small together. They can change the investment landscape. And by the time the average investor realizes it, the people who moved early may already be positioned. That is why the message is simple. Do not be afraid of the changing world order. Study it. Do not panic about the dollar. Understand it. Do not abandon the United States. Balance it. Do not chase every headline. Look at the system, because the system is telling us something very clearly. The old world, where the United States was the only center of gravity, is becoming a new world with several centers of gravity. That creates risk. It also creates opportunity. If you are overexposed to the old world, the risk is larger. If you adapt thoughtfully to the new one, the opportunity is larger. The people who benefit most will not be the people who predict the exact year China overtakes America, or the exact year India becomes a $10 trillion economy, or the exact level where the dollar's reserve share bottoms. They will be the people who recognize the transition, position themselves intelligently, and let time do the work. That is usually how wealth is built. Not by reacting to every headline, not by making one dramatic bet, not by pretending the future is certain, but by seeing the big cycle, understanding the incentives, and building a portfolio that is not dependent on one version of the future. That is what I would do, and that is what I believe many investors need to do now before the shift becomes obvious to everyone else. Because when a world order changes, the cost of waiting can be very high. The dollar does not have to collapse for your purchasing power to weaken. America does not have to fail for other markets to outperform. The S&P 500 does not have to crash for future returns to be lower. Emerging markets do not have to be perfect to deserve a place in a portfolio. Gold does not have to become money again to hedge paper currency risk. Commodities do not have to become the whole strategy to protect against inflation and supply shocks. Small shifts matter. Small allocations matter. Small changes made early can create large differences over time. And that is why I believe this is one of those moments investors should not ignore. Not because it is the end of the dollar, not because America is finished, not because China or India will make every investor rich, but because the world is clearly becoming more complex, more multipolar, and less forgiving to people who only know how to invest in one environment. The old environment rewarded home bias. The next environment may reward global awareness. The old environment rewarded blind confidence in the dollar. The next environment may reward currency diversification. The old environment rewarded owning the same U.S. mega-cap winners everyone else owned. The next environment may reward looking where capital has not fully gone yet. That is the real story. And if you understand it before most people do, you do not need to be afraid of it. You can prepare for it, you can position for it, and then you can let the world change while your portfolio is already built for that change.